And it's a seesaw day in financial markets. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And after a very inconclusive, let's call it, response to yesterday's Fed policy announcement, stocks find a way higher today. In between then and now, there's also been a wild ride for the US dollar, which didn't like the Fed, then liked what happened after, then didn't like anything again because the Bank of Japan intervened into the yen. And so the markets are all over the place here, but hopefully we stand on the cusp of a bit of clarity here as we get the first big piece of U.S. economic data to come in the Fed's wake. And of course, what I'm talking about here is April's U.S. jobs report. So what we're going to be looking at here will be what's coming out, why it matters, and whether it can finally give these markets some direction. Well, and by the way, that's whether the outcome is good, bad, or indifferent as relative to forecasts. So first, let's do a bit of stage setting. These are the expectations. Markets are looking for the economy to add 243,000 jobs to non-farm payrolls. That's well within the range that has persisted really since the middle of 2022. This sort of 303,000 to 165,000 that's been the norm here basically since late 2022, early 2023, would very much be the confines for where we're expected to land, and somewhere near the average. The same for the unemployment rate. It's seen coming in for a second month at 3.8%, somewhat toward the upper edge of the range from 4 to 3.4 that we've seen going all the way back to the latter half of 2021, but well within that as well. So no big controversy there, it would seem, if we get outcomes that are broadly in line with expectations. Now, the number that might be the most eye-catching of the bunch is a proxy for wage inflation, that is the average hourly earnings number. Year on year, it is expected to come down to 4%. Now, this may well be the most eye-catching bit in the equation, because the last time that we had wage inflation that was that slow was back here. Note that we've been above 4% here since about June of 2021. So if we come down and hit that here, it would be a very welcome sign for a Fed that yesterday seemed to signal as forcefully as it could. Yes, we are going to hold rates higher for longer because inflation has been hotter, but we are in no rush to hike, and that is not the conversation we are currently having. We're having a conversation about how long we need to keep rates at current setting to get them enough time to work to bring inflation into the direction that we want. Now, Fed Chair Powell cautioned in his press conference after the yesterday's meeting that to target the labor market explicitly and to target wage inflation explicitly as a number is not their intention, despite the fact that, of course, the Fed's dual mandate calls for them to secure maximum employment in a context of price stability, as defined by inflation of 2% over the medium term. So it's in the mandate. But apparently what the Fed chair is telling us is we shouldn't focus on this or that wage number necessarily. Nevertheless, this is, of course, a critical input into the Fed's calculus, and this is really why we ought to care about this report at all. Consider here there has been a significant decline in inflation from a peak of 9% to 3.5% on CPI, from a peak of 7.1 to 2.7% on PCE. Significant declines. Inflation has cooled by more than half. But if you look at what's going on in the labor market, we just saw updated employment cost index numbers for the first quarter earlier this week. The decline has been much less pronounced. And much of the reason that we seem to have stopped seeing inflation progress at some point in the middle of last year, you can see that right here, whether it's the PCE set or the CPI set that we're looking at, seems to be that wages at a higher level are locked into the service sector. At this point, of course, goods inflation is next to nothing. In fact, slightly negative in the last CPI number. There's really not much to talk about with food inflation or with energy. Energy is mildly negative, again, as a contribution to inflation. If we look at the very latest numbers, that is the PCE report that we saw last Friday, we see there that the numbers for February and March had goods negative, energy negative, food negligible, and inflation in the service sector about double the other next component, which was housing. Now, we've said for a long time here on Macro Money that the Fed can't really do much about housing inflation until it cuts rates, because it is the reason that inflation is arguably locked up in housing. And it needs to cut rates to clear that market and bring both sellers and then buyers into the fray. This is because rates are so much higher now than people's mortgages are fixed at, that nobody wants to sell and then refinance at mortgage rates for their next home that are anywhere between 1.5 to 2 times higher. That means that very few people are selling. If very few people are selling, that means very few influences for prices to come down exist. And so very few people are buying. They feel priced out, both by mortgage rates and by the fact that the price is not really coming down because sellers aren't really selling, so the market isn't really clearing. That's not really anything the Fed can do anything about until it cuts rates. So it's this service sector issue and the labor market essence of that issue that really drives this story going forward. And if we look at what we see in the market's response so far, we clearly see that it's probably that average hourly earnings number that really matters more than anything, because that's the number that speaks most directly to what we are going to get as a response. Because until there is progress on wage inflation, the Fed is ostensibly not in a position to cut rates, which of course is exactly what the market wants them to do. So with that in mind, how does this data set up to come out here based on reading the tea leaves from the leading influences? Well, we got a whole bunch of them this week. The ADP number, which isn't always the greatest foreshadowing of the Fed, and needless to say, the NFP number that is going to be the influence on what the markets do with Fed policy expectations. That came out a little bit better, 192K versus 175 expected. Now, as we can see here, also well within the recent range, not really anything dramatic here, but a touch stronger. Does that necessarily mean that NFP is going to be a touch stronger? Well, that connection doesn't really hold up over time, but the inverse doesn't really hold up over time either. So we'll have to see, but at least looking at the private payrolls foreshadowing from ADP, there's a slight skew to the upside. It is a different lead from the JOLTS survey of job openings and turnover. What we see here is a much smaller number than expected, and also a much smaller number relative to history. Tellingly, we haven't seen a number this low for job openings since June of 2021. And to the extent that this might speak to maybe some additional pressure on wages, this could be a welcome sign if you're a stocks bull or a Federal Reserve policy official. Looking at the ISM surveys, we haven't had the service sector one yet. As of March, both service sector and manufacturing numbers for this index were in contraction territory. So employment was actually on a contracting trajectory. This is, of course, done in the logic of PMIs. And so above 50 is growth, below 50 is contraction. And the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what we're looking at ostensibly here is a labor market that we can squint seems to be sloping toward a weaker setting over recent years. And as of March, had contracting employment growth across both of the key non-farm sectors. We've already seen the manufacturing numbers for this week. We can see that the pace of contraction eased in April, at least on that side of the story, but only a bit. We'll see what the service sector side is going to show us. The expectation is that we're going to see another sub 50 number, but we'll see to what extent. What we can look at as a kind of overall catch-all perspective here is that we have, on the whole, over the past 2.5 weeks or so, seen U.S. economic data increasingly deteriorate relative to forecasts. We can see that from these numbers out of the Citigroup U.S. Economic Surprise Index. This tracks the way data outcomes perform relative to forecasts. If they outperform, the index goes up. If they underperform, it goes down. And it seems to be very responsive, yet again, to its 20-day moving average. That's about, give or take, a month's worth of activity. 4 weeks in a month, 5 days in a week. About 20 days is a month's worth of business days or market days on which data comes out that factor into this average. And it seems to be that when you go through it, either going up or going down, this finds follow through. Talked about this a couple weeks back and said, look, it's crossing back over its 20-day moving average. It might be that there is a period of underperformance for U.S. economic data where models need to readjust. That's starting to take shape. Well, indeed, the data has extended into underperformance, and we're now at this point basically in line. So the market seems pretty well priced. Models seem to be broadly aligned with what's going on if they are retuned to this setting, because we can see now that the gap between data outcomes and forecasts is essentially deteriorated into, give or take, no gap whatsoever. So this may set the stage, if these latest forecasts still reflect these kind of laggy models against which the data has been deteriorating. If that's what we see as setting the stage for a soft set of numbers out of this jobs report, we could very well be looking at slightly softer NFP, slightly less attractive unemployment rate numbers, maybe a further push lower on wages. Now, the key here is perhaps not even what comes out, but how the markets read it. And the seesaw that we saw following the Fed policy announcement yesterday really seems very instructive. This is the ES future that tracks the bellwether S&P 500 here. And we can see that the markets loved what the Fed had to say until they didn't, which was, of course, very eye-catching because one could reason why they liked it. The Fed offered what was probably the most benign version of a higher for longer hawkish adjustment in the guidance. An adjustment that everybody ostensibly saw coming. The markets were already slashing rate cut expectations into yesterday's Fed meeting, and we're sitting at one cut that was baked in relative to the Fed's forecast for 3, updated as recently as March 20th. So the markets already knew there had been some hot inflation data, including ECI, the Employment Cost Index, speaking of wages, earlier this week. And so they knew the Fed was going to have to issue some kind of a hawkish pivot. The question was how benign of a pivot it would be. And we talked about this yesterday on the show. On the dovish side of the spectrum, there was, we still think we're going to have room to cut rates this year, just not as much and not as soon. And that's essentially what the Fed said. Whereas the more hawkish versions would be, maybe we don't have the room to cut rates this year, or worse yet, for bulls anyway, maybe we have to hike because inflation's getting out of hand. Well, if we look at how the market responded, it makes sense until there is capitulation. And therein is seemingly the key. If the market couldn't like even a Fed policy announcement that the price action itself smiled upon, then there is really and truly something very bearish about what's going on here. The same logic applies to this incoming U.S. jobs report. If the tea leaves as they appear suggest that indeed we are going to get something of a soggier set of numbers, the presumption would be, oh, well, this endorses the Fed's view that you just have to give policy as it stands more time. We don't need to make credit any more expensive. Inflation will work itself out. Let's just sit here. Well, then the preponderance of bad news will have been priced in. At this point, the markets are sitting at about 32 basis points baked in for this year. So that's at least one cut and about 18 basis points of a second one baked in. So at this point, the markets see about a 72% chance that there is that second cut at some point this year. If a soft jobs number endorses that, that would suggest that maybe the markets don't have to fear a more aggressive Fed rethink. But then, of course, the question becomes, can they make hay of it? Or will they fumble the ball like they did after the Fed yesterday? If the numbers are soft and the market takes that as a positive sign, perhaps there is follow through there and we've found a clearer path upward. But if the market gets a soft number and they can't make a significant advance on that basis, well, then that would be 2 times this week that outcomes that ought to have been supportive weren't. And that would be a very ominous sign indeed. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may follow thereafter. I'm back on with Chris tomorrow, as I am every Friday, for Futures Power Hour. I'm back on with Tom and Victor for First Call on Sundays. Then again with Victor on Wednesdays for The Price of Truth. Writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. Good luck trading. Speak to you on Futures Power Hour tomorrow. Macro Money back next week.